California's 2025 real estate downturn is unfolding with unprecedented speed, depth, and severity. Across the state, average home values remain above $750,000, yet a significant buyer exodus has occurred, leading to an inventory surge exceeding 60% in certain locales. Monthly mortgage obligations now frequently surpass $6,500 in many areas, starkly contrasting with flat wage growth, thus creating an insurmountable affordability barrier. Foreclosure rates are escalating sharply, showing year-over-year increases of 30 to 45%. Properties that once sold in a matter of days are now languishing on the market for 60 or more days, accompanied by substantial price reductions. This scenario is transforming once vibrant suburban communities into the precursors of America's next wave of ghost towns, a stark real estate miscalculation. Number 10. Mission Viejo. Mission Viejo, formerly an emblem of Orange County's stable middle-class prosperity, is now exhibiting alarming indicators within the 2025 housing market. With a median property cost in mid-2025 hovering near $1.24 million, home values in this city have appreciated by almost 83% since 2020. However, this rapid appreciation may have outstripped sustainable demand. Local property listings have increased by 38% year over year, while buyer engagement has diminished by over 27%. Data from regional multiple listing services indicates that homes previously selling in less than 2 weeks are now taking an average of over 45 days to find a buyer, signaling a considerable cooling of market demand. The persistent affordability challenge has emerged as Mission Viejo's critical vulnerability. The median household income stands at approximately $117,000, while a typical mortgage requiring a 20% down payment at an interest rate of 6.7% necessitates a monthly outlay of around $7,100. This represents more than 70% of gross income for numerous households. This disparity between income and debt is effectively excluding younger purchasers and compelling even long-term residents to seek more economical areas further inland, such as Menifee or Murrieta. Inventory levels have surged, with nearly 1 in 5 available properties undergoing price reductions. Foreclosure and pre-foreclosure filings have seen a 19% rise since the fourth quarter of 2024. A particularly concerning trend for a city that experienced relatively low delinquency rates during previous economic downturns. Commercial hubs, such as the Shops at Mission Viejo, are now contending with elevated vacancy rates, and restaurant closures have risen by 12% year over year, according to the Orange County Business Journal. A more unsettling demographic shift is also apparent. Mission Viejo's population has contracted by 2.1% since 2022, as both retirees and younger families are opting for more budget-friendly regions. Enrollment in public schools has also declined by over 5%, suggesting a shrinking base of families. With fewer new residents, stagnant earnings, and exorbitant housing expenses, Mission Viejo's well-maintained streets now resonate with a subdued, unsettling quietude. Should current trajectories persist, this once thriving suburb could very well become one of Orange County's initial major post-pandemic ghost towns. Number 9. Costa Mesa. Costa Mesa, renowned for its lively arts community and strategic Orange County location, is now confronting the challenging repercussions of an overheated real estate market. In early 2025, the median home price in Costa Mesa reached $1.38 million, a figure nearly 95% higher than pre-pandemic levels in 2019. While this city has historically attracted professionals, artists, and entrepreneurs, it is now experiencing a rapid market contraction. Housing inventory has increased by 41% year over year, and properties are remaining on the market for an average of 52 days, a significant jump from merely 19 days a year prior. The affordability crisis is particularly acute here, with a median household income of approximately $13,000 per month. Monthly mortgage payments for a standard residence now exceed $7,800, consuming over 90% of the take-home pay for many buyers. This has effectively priced out the younger creative and tech professionals who were once drawn to Costa Mesa's pedestrian-friendly neighborhoods. Rental costs, which previously served as a market stabilizer, have also escalated to an average of $3,450 per month, contributing to a net population decrease of 2.8% over the last 2 years. Small businesses are also feeling the economic strain. Retail vacancy rates have doubled since 2023, and commercial lease rates have fallen by 17%. While cultural attractions like the LAB and the Camp continue to attract visitors, numerous boutique shops and independent eateries have ceased operations, leaving behind vacant storefronts. Office space availability has surged by 26%, indicating that remote work trends and business closures are having a substantial impact. Costa Mesa's once dynamic character has slowed considerably, exacerbated by high property taxes, escalating insurance costs, and mortgage rate volatility fluctuating around 6.6%. Even long-standing homeowners are contemplating relocation. If these trends persist, Costa Mesa could transform from a creative hub into a stark cautionary example of the consequences when real estate expansion outpaces economic realities. The city's vibrancy is diminishing, and many fear that its essential character may be the next to fade. Number 8. Aliso Viejo. Aliso Viejo, a meticulously planned community nestled within the undulating hills of South Orange County, once embodied the quintessential vision of modern suburban life. However, in 2025, the reality of this locale is undergoing a swift transformation. Home prices here are currently around $1.02 million, nearly 88% above the historical average for similarly sized Southern California suburbs. This growth, propelled by speculative investment and limited supply during the pandemic era, is now proving detrimental. Over the preceding 12 months, new listings have surged by 45%, and properties are now taking an average of 56 days to sell, a significant increase from the mere 14 days recorded in early 2023. The typical household income in Aliso Viejo is approximately $112,000. Despite this, monthly mortgage payments now approach $6,400, not including property taxes and insurance. Consequently, a substantial number of prospective buyers are being priced out, particularly first-time homeowners who are facing record-high interest rates. The city's population has decreased by 2.3% over the past 18 months. Rental occupancy is also declining, with landlords resorting to incentives such as 1 month of free rent simply to fill vacant units. Aliso Viejo's once thriving corporate office parks are experiencing a gradual decline. Commercial vacancy rates have risen by 21%, and several office buildings along Aliso Viejo Parkway are now underutilized or entirely vacant. This situation adversely affects the city's tax revenue and places additional strain on local public services. Nearby retail centers are exhibiting a comparable downturn, with reduced traffic flow and major retailers reassessing their lease agreements. Of particular concern is the increase in foreclosure activity. In the first quarter of 2025 alone, Aliso Viejo recorded a 31% increase in foreclosure filings compared to the prior year. Homeowners who purchased properties at peak prices between 2021 and 2022 are now in a negative equity position, with many choosing to walk away from mortgages that are no longer financially viable. Aliso Viejo's meticulously planned streets remain immaculate and tranquil, but this calm now carries an unsettling undertone. With diminishing buyer interest, escalating debt burdens, and rising vacancy rates, the city's polished exterior is beginning to show signs of strain. Number 7. San Clemente. San Clemente has long been cherished as a picturesque coastal sanctuary in southern Orange County, celebrated for its Spanish architectural style, dramatic ocean bluff vistas, and world-class surfing opportunities. However, in 2025, the city's high-end real estate market is exhibiting pronounced signs of deterioration. The median home price currently stands at a substantial $1.72 million, positioning it nearly 106% above its long-term historical average. While the city historically attracted affluent retirees and purchasers of vacation homes, the prevailing economic conditions are rendering this luxury market unsustainable. Mortgage rates hovering around 6.7% have made financing these properties exceptionally challenging. A conventional 30-year fixed mortgage on a typical San Clemente residence now necessitates monthly payments of $9,800, effectively excluding nearly all median income earners in the area. The average household income is approximately $118,000, meaning that only the top 10% of earners can realistically afford to purchase a home here. Listings have climbed by 49% year over year, and price reductions are being implemented on close to 40% of all currently available properties. Demand for rental properties is also softening. The average rent for a two-bedroom unit is now $3,750, and occupancy rates have dipped by 5.2%, prompting landlords to offer concessions not seen since the Great Recession. Concurrently, population growth has stagnated, with a net population loss of 1.9% since 2023. Remote professionals who once fueled the market are now seeking more affordable options in inland communities. Tourism, a previous economic buffer, is no longer sufficient. Boutique hotels are struggling to maintain occupancy amid soaring insurance premiums, and several businesses situated along the beachfront have closed due to reduced customer foot traffic. Downtown shops and eateries are reporting a 16% decrease in sales compared to the previous year. San Clemente continues to boast exceptional natural beauty, but this aesthetic appeal alone cannot sustain the financial obligations associated with home ownership. The market has fundamentally shifted, and unless property values experience significant corrections, San Clemente risks becoming a muted coastal echo of its former self, a serene beachfront ghost town awaiting an economic reset. Number 6. Tustin. Tustin, situated between Irvine and Santa Ana, has historically served as a more affordable entry point into Orange County's housing market. However, in 2025, even Tustin is experiencing a rapid housing correction that poses a threat to its economic stability. The median home price now hovers around $1.21 million, an increase of more than 87% since 2019. With mortgage rates at approximately 6.7%, monthly mortgage payments for a median-priced residence exceed $7,000. While the median household income is only around $15,000. This significant debt-to-income imbalance is deterring buyers and causing inventory levels to skyrocket. Listings have increased by 42% year over year, and properties are now spending an average of 54 days on the market, a notable increase from the 18 days recorded during the 2021 market boom. Nearly 35% of available properties are undergoing price reductions, and numerous sellers have withdrawn their homes from the market entirely rather than accept lower offers. Rental properties are not exempt from these pressures. Rents have stabilized at approximately $3,300 per month, but vacancy rates have risen to 7.1% from 4.5% just 1 year ago, further contributing to downward market pressure. Tustin's small business sector is showing signs of strain. Commercial vacancies have increased by 22%, and local restaurants and retailers are struggling with both decreased foot traffic and escalating operating costs. The previously consistent influx of remote workers and young professionals has slowed considerably, accompanied by a 2.4% population decline since 2022. Foreclosure filings have escalated by 28%, specifically among homeowners who acquired properties with variable rate home loans amidst the 2021 interest rate slump. Those who strained their finances to enter Tustin's appreciating market are now confronting significantly larger payments they struggle to manage. Tustin still provides its inherent appeal, central location, and historic districts, but these advantages are being overshadowed by financial strain, unaffordable housing costs, and escalating economic instability. Without a substantial market adjustment or a concerted revitalization initiative, Tustin faces the risk of devolving into a dormant community characterized by elevated prices, minimal property transactions, and a growing number of vacant residences and commercial establishments. Number 5. Modesto. Modesto, once perceived as a sanctuary for individuals relocating from the Bay Area to escape exorbitant living expenses, is now encountering its own period of decline. As of the middle of the year 2025, the average home price in Modesto stands at approximately $410,000, a decrease from its zenith in 2022, which was close to $460,000. This 11% reduction might seem minor, but it is accompanied by a substantial 52% increase in available properties, indicating a pronounced imbalance in the market. Prospective buyers have diminished in number as mortgage rates approach 6.8%, pushing monthly loan payments beyond $2,800. This represents a considerable increase for a region where the median household income is merely $66,000. During the economic surge of the pandemic, Modesto became a popular destination for remote employees and investors. However, that trend has now reversed. Property values have declined. Rental rates have remained stagnant at around $1,800 per month, and population expansion has ceased. In fact, the city experienced a 1.7% reduction in its resident population over the past year, a sharp contrast to the influx observed between 2020 and 2021. An even more concerning development is the rise in foreclosures, which have increased by 34% compared to the previous year. Many of these defaulted loans are linked to purchasers who entered the market with minimal down payments and now owe more than their property is worth. The number of homeowners with mortgages exceeding their property's value has climbed to 13%. Furthermore, late payment rates are on the rise, particularly in areas east of McHenry Avenue and south of the city center. Commercially, the city's shopping centers and retail corridors are exhibiting clear signs of distress. Vacancy rates have surpassed 18%, and job losses within the service and warehousing sectors have contributed to rising unemployment, which currently stands at 6.4%, significantly higher than the national average. Modesto's reputation for affordability has unfortunately become a financial pitfall for many, with falling property values, stagnant incomes, and diminishing buyer interest, painting a bleak economic outlook. Once considered a secure escape from California's high cost of living, Modesto is now among its most vulnerable real estate markets as the second half of 2025 approaches. Number 4. Riverside. Riverside, long regarded as the core of the Inland Empire, is undergoing a disconcerting transformation as the housing market downturn of 2025 progresses. Once a haven for families displaced by unaffordable coastal cities, Riverside's property market has reached unsustainable levels. The current average home price is $565,000, an increase of more than 68% from its 2018 valuation. However, indications of overvaluation are now prominently displayed. With mortgage rates still exceeding 6.6%, monthly payments for a median-priced home surpass $3,800, while the median household income in Riverside is around $74,000. This disparity is compelling many prospective buyers to postpone their purchases or relocate entirely. The supply of available homes has dramatically increased, with active listings rising by 47% year over year. The average duration a property remains on the market is now 59 days, a significant jump from just 21 days 2 years ago. Thus, approximately 33% of homes have undergone price reductions, and seller concessions, such as interest rate buy-downs and contributions towards closing costs, are becoming commonplace. Foreclosure filings have surged by 39%, especially among homeowners who acquired properties using FHA loans with minimal equity during the intense buying period of 2021 to 2022. Rental markets are also experiencing strain. The average rent is approximately $2,650 per month, but vacancy rates are increasing, and property owners are finding it challenging to attract suitable tenants. Concurrently, job creation has decelerated. The logistics and warehousing sector, which was previously Riverside's economic driving force, has experienced workforce reductions and contractions due to decreased shipping demand. Unemployment has risen to 5.9%, undermining the region's economic stability. The commercial real estate sector is also feeling the pressure. Retail vacancies have increased by 14%, and several neighborhood shopping plazas display evidence of prolonged neglect. With declining home values, escalating defaults, and a slowdown in economic expansion, Riverside's trajectory is shifting from a regional success story to a cautionary example. If current trends persist, Riverside could soon resemble a post-boom ghost town, where inflated prices and an over-reliance on volatile industries leave residential areas partially occupied and homeowners' equity diminishing monthly. Number 3, Bakersfield. Bakersfield, frequently recognized as California's energy hub, experienced a housing market boom fueled by the pandemic, which led to substantial population migration and inflated property valuations. However, in the year 2025, the situation has reversed. The current average home price is around $390,000, down from a peak of $440,000 in late 2022, representing an 11% decrease. While still considered affordable by Californian standards, the city is now witnessing a faster than anticipated decline in housing demand. Listings have surged by 58% year over year, and homes are now staying on the market for an average of 61 days, double the duration observed in early 2023. The median household income in Bakersfield is approximately $63,000. Nevertheless, the average monthly mortgage payment for a new purchaser now surpasses $2,600. With mortgage rates hovering near 6.9%, affordability has drastically decreased. Many purchasers who entered the market during the remote work expansion are now seeking to exit, often incurring losses. Consequently, foreclosure activity has escalated by 41%, and properties with negative equity are reappearing, particularly in newer housing developments on the city's western side. Bakersfield's economy, which is heavily dependent on oil, agriculture, and logistics, has also weakened. Recent job cuts in the warehousing sector, coupled with reduced oil demand, have pushed unemployment to 7.1%, significantly exceeding the national average. This has had a ripple effect on the housing market, resulting in more sellers than buyers and developers postponing new construction projects. Renters are not exempt from this downturn. Average rents are around $1,650 per month, but vacancy rates are increasing, and property owners are beginning to offer concessions. Retail centers are also experiencing the economic slowdown. The closure of several large retail establishments has left entire shopping complexes empty, and commercial vacancies have risen by 19% year over year. What was once perceived as a rising star in the Central Valley is now on precarious footing. With declining prices, job losses, and increasing vacancies, Bakersfield is gradually moving towards economic and residential stagnation, transforming formerly vibrant neighborhoods into eerily quiet streets. Number 2. Stockton. Stockton has long been emblematic of housing market instability. Following its bankruptcy declaration in 2012 and experiencing one of the nation's most severe foreclosure crises, the city had achieved a robust recovery. However, in the year 2025, Stockton's housing market is once again precariously positioned. The average home price is now $420,000, a decrease from $475,000 in 2022, representing a 12% decline. While still relatively affordable, this drop has been exacerbated by a surge in available listings, which have increased by 55% year over year, and a dramatic fall in demand. With interest rates hovering around 6.8%, the monthly mortgage payment for a median-priced home now exceeds $2,850. A difficult sum for a city where the average household income is $62,000. These financial calculations are unworkable for most families, compelling more prospective buyers to withdraw from the market. Delinquent payments are rising sharply, and Stockton has witnessed a 38% increase in foreclosure filings since the second quarter of 2024. Many of these are linked to buyers who entered the market during its frenzied pandemic peak. Rental properties have also not been spared from the economic downturn. Average rents are holding steady at around $1,750 per month. But with rising vacancy rates, property owners are significantly reducing prices or offering incentives to retain tenants. The city's population, which experienced rapid growth between 2020 and 2021, has since decreased by 2.9%, as remote workers either return to major urban centers or relocate out of state entirely. Economic pressures are also intensifying. Stockton's unemployment rate has risen to 6.8%, driven by layoffs in the retail, logistics, and public service sectors. Meanwhile, commercial development has slowed, and small businesses are closing their doors. Some neighborhoods that were once bustling with new construction now appear partially deserted, with unoccupied homes and "for sale" signs lining the streets. Stockton is once again caught in a detrimental cycle of falling prices, increasing foreclosures, and declining confidence. Despite previous recovery efforts, the city's housing market in 2025 feels uncomfortably similar to its most challenging periods, with the warning signs appearing even earlier. Number 1. Irvine. Irvine has long been regarded as the epitome of suburban achievement, characterized by its meticulously planned communities, high safety ratings, and pristine environments. However, in the year 2025, it is emerging as the focal point of California's housing market collapse. The average home price in Irvine is an astonishing $1.62 million, and despite its esteemed reputation, this figure is now working against the city. With 30-year mortgage rates near 6.9%, the monthly cost of homeownership exceeds $10,000, pricing out even individuals earning six-figure salaries. Meanwhile, the median household income, although higher than in most cities at $118,000, is still insufficient to comfortably cover current mortgage obligations. The inventory of available homes has dramatically expanded. Active listings are up by 63% compared to the previous year, and properties are now spending an average of 66 days on the market, a stark contrast to the mere 12 days recorded during the 2021 peak. Nearly 38% of homes have experienced price reductions, and buyer interest has virtually vanished. Foreign investment, which was once a catalyst for Irvine's luxury real estate boom, has significantly diminished due to global economic uncertainty and more stringent lending regulations. Rental markets offer no respite. The average rent for a two-bedroom apartment is now $3,950 per month, yet vacancies are increasing as renters move inland or relocate outside the state. The population growth that previously fueled Irvine's expansion has stalled. Net migration has been negative since mid-2023, and school enrollments have declined by 4.1%. Commercial properties are not faring any better. Office vacancies have risen by 22%, and several mixed-use developments are experiencing construction delays. Escalating homeowner association dues, increasing insurance costs, and substantial property taxes are compounding the financial burden for residents, precipitating a wider departure. While still at a low level, the number of foreclosures has seen a 31% increase. This trend is particularly evident in recently constructed upscale neighborhoods, where purchasers had already stretched their financial capacities to their limits. Absent significant reductions in property values or governmental assistance, Irvine appears destined to serve as a stark warning. It is a luxurious, costly suburban area with an oversupply of residences and a deficit of purchasers, experiencing an economic downturn due to its own internal pressures.